Hey folks, welcome back to the channel, and I'm really excited to share one of my favorite option strategies today, the bear call spread. I've been using this to make about $1,000 per week in the markets, and as I'll explain in a minute, this works really well in a flat to down market, kind of like what we've had this year so far. And I've already received multiple requests for this topic, because it does seem like a popular strategy that people are interested in. So in today's video, we'll go over what the bear call is and why it's so versatile. I'll also be showing some real-world examples of how you can use this strategy, and we'll look at the outcomes of those trades and see how they turned out. Now, just like any other option strategy, there is a time and place to use the bear call. You don't want to use it just on any stock at any time, so I'll explain the specific types of situations where you can have a high probability of profit. And of course, I'll also explain when not to use it to increase your success rate if you do decide to give this strategy a try. And since this is a spread, the downside risk is defined. So even if your trade doesn't work out, you won't be losing too much money, depending on how wide your spread is. So let's get started. So what is a bear call spread in simple terms? Well, it's basically a short call with protection. Now, what is a short call? Well, that's when you're selling a call option to make some income. So for example, let's say we have National Bank here, which is trading at $92 today. And let's say your friend is a call option buyer because they're speculating on the stock. And they think that by next year, National Bank will go up to maybe $150 per share. So if they buy 100 shares of National Bank today and the stock price goes to $150 by next year, then they would have made $58 per share times 100 or $5,800. And they're so sure that they're right that they can't wait to make this trade. However, there is a problem. They don't have the money it takes to buy 100 shares of National Bank, because at $92 per share times 100, they need to come up with $9,200, which they don't have. But they do have $500. So by purchasing a call option, they can benefit from all of the upside potential gain without spending a huge amount of capital up front for the shares. So let's take a look at National Bank's options chain, and this is looking at I'm doing a leaps here, so this is going to January of 2024, but just to prove a point, let's say at a strike price of $100 here, you can see that the price of the option is about $5. And if you multiply that by 100 shares per contract, that's going to be about $500. So what your friend can do is pay somebody $500 or somewhere between the bid and ask price for the right to purchase 100 shares at $100. And if at expiration, National Bank goes up to $150, then they can exercise their option and basically purchase the share at $100, which is the strike price, even though the actual shares on the open market are worth $150. So they just made $50 multiplied by 100 shares. That's $5,000. So they turn $500 into $5,000. Now, that is assuming National Bank actually goes up that high. Now, most likely that's not going to be the case. Canadian banks are not known to be that volatile, but that's just to prove a point. So how would that look like on a chart? Well, it would be something like this. National Bank is right now trading at $92. So this is the current price. And your friend wants to buy a call option for $500. And let's say you're the person who wants to sell it to them. So that's why you are short the call option. Short meaning you're short selling or you're selling the call option to someone else. And in return for that risk, you're getting $500. So the max profit that you can actually make is the $500 in premium that your friend pays you. Now, at expiration, your actual profit will depend on the price of the underlying stock. So this gray line here is the price of the stock. If the stock ends on expiration right here at $100, you will make the maximum profit of $500 because there's no reason your friend would exercise their right to buy 100 shares of National Bank from you for $100 if they can get it in the market for cheaper than that. So if the stock ends at $95, $85, whatever, we say the option expired out of the money, which basically becomes worthless. So the option holder, your friend in this case, just lost out on $500, but that was a bet that they were willing to take. And your bet was to think that the stock would not go up too much. Now, what if the option expires when the shares are trading at $105, which is right here? You might think, well, does that mean you lose $5? Because you're selling the stock for $100, which is $5 less than what you could have sold in the open market. But actually, if you account for the $500 that you've made, you would actually be break even. Now, how you would lose money is if the price of the stock were to go above $105. So let's say it goes to all the way over to $150, like what your friend predicted. Well, that's going to cause you a lot of pain because, especially if you don't already have the underlying in your portfolio, what you have to do is go to the open market, buy the shares for 150, and then sell it to your friend for 100 because that's the contract that you made with them. You do have a small reprieve because you did make $500 from selling the option, but even then, you're looking at a $45 loss times 100, that's a lot of money on this single trade that you've lost. So that's pretty much how a short call works is you're betting that the stock will not go above a certain price in the future. The downside of this, of course, as we just saw, is you can lose a ton of money if the trade were to go the wrong way, like if the stock were to go up a lot. And technically, there is an undefined loss because if the stock goes to $1 million, then you have to pay $1 million to buy the shares, even though you can only sell it at whatever the strike price is. So, how do we prevent this from happening? Well, we can make a spread. And what that will do is basically limit our downside so that we don't have an unlimited loss. And instead, we limit our loss depending on how wide we make that spread. So, how do we limit our loss here? So that even if the stock price goes up substantially, at a certain point, we say, okay, that's enough. That is the most I'm going to lose. And we basically protect our downside starting from that point. Well, the way we do that is we buy another call option that is at a higher strike price than our original option that we sold. This is the call option strike price that you're selling at. And then what you can do is go to a higher strike price, let's say $105, and you basically buy that. And you can see right now on the same expiration date, you'll probably have to spend about maybe $3.40, just looking at the midpoint between the bid and the ask there. So why does buying the 105 call option protect you from the downside? Well, it's because if you are the owner of the option, if you bought it, then of course you can exercise it. So it doesn't matter if the stock is at $150, you can buy it from someone at 105 and you can sell that to your friend at $100. So here's another example of what a bear call spread will look like. This is the strike price that you would sell, and this is the strike price that you would buy. And let's say the stock today is trading at maybe $28. Because the sold call is closer to the money, you're going to get a higher premium selling this, and you're going to pay a lower premium when you buy the $34 call option because it's farther away from the current price of the underlying, which means the option price will be lower. So you're selling this one to make money, and then you're buying this one, which costs less money, and the difference between the two is the spread, and that's what you make. So if the stock price were to go up a little bit, from $28 to 30, well, you would make $200. Goes up and down, but doesn't really move at all, ends up at 28, you would still make money. If it goes down to whatever, you would still make the $200 maximum profit. So this kind of strategy works really well if you're bearish on a stock or if you don't think it's going to grow too much. In this case, if it goes up to 32 or higher, then that's where you're going to start losing money. But of course, you can also close out your position early. And that's why it's called a bear call spread, because you're bearish on the stock. You don't want the stock to go up. And then it's the call because you're only selling and buying call options with these. And it's a spread because, like we just talked about, you're creating a spread between two strike prices. So now that you understand why it's called a bear call spread and how it works, let's talk about what kind of situations would be appropriate for you to use this strategy. Well, the first type is with index funds. So let's take a look at the SPY, for example, which is just the S&P 500. Notice how the volatility isn't very high. Looking at the 1-year chart here, so the highest it's been is 477 and it went all the way down to 365. So that's within like 100 points for a 400-point index right now. So that's not a lot of volatility over the course of the year compared to maybe some tech stocks that can go up and down like 50% in a single year. So the advantage of index funds is because they are a basket of many individual stocks, you're not likely going to get a huge move in one way or the other. And when you're trading options, it's nice to have that kind of certainty, that level of stability, that you know the underlying here isn't going to drop like 30% because it missed expectations on its latest financial report. Whereas for individual companies like Rent the Runway recently released earnings just this week, and they actually lost subscribers, I think. So their stock is down 31%. That's what you don't want to happen, especially when you're playing with options, because options do use leverage. So if a stock goes down 31% and you're positioned improperly with your options, you could lose like 200%. In the particular case today, we're dealing with bear call spread. So actually, this would not hurt you at all because you want the stock to go down, if anything. But let's say you were using the bear call spread on a company like Acro. Well, that's up 115% today. So that's why indexes are really good for options, including something like the bear call spread. So I'm going to take a look at QQQ, which basically tracks the NASDAQ 100, and it's down a lot today. That's because CPI came out and it was higher than expected. So the markets are still digesting this information. But the three indexes I would consider doing the bear call spread on would be Triple Q, as well as the SPY, which we looked at, and also IWM, which is the Russell 2000. All of these indexes have enough individual components in them to kind of smooth out any ups and downs in turbulent times like today. So let's go ahead and take a look at QQQ in the option chain and see if we can create a bear call spread for, well, today is Tuesday, and I was waiting for today to make these trades because I had no idea what CPI was going to be, and I did not want to risk it. So I guess that's like a hot tip. If you know that a pivotal economic data is about to come out, especially if it's like earlier in the week, do not make any trades before then because the markets can move very unpredictably. So I'm going to choose an expiration date of Friday, September 16th, and that way all of the options that I'm going to use as examples will expire, so we can take a look at how they did. But obviously you can do monthly options, which gives you more time and you do less work that way. Like instead of tracking your options weekly, you can just do it once a month. But it's completely up to you. But I'm going to choose September 16th here as my expiration date. And the ETF is currently trading at, let's say, 297. Let's say 297 is right here. What I basically want to do is choose a strike price that I can sell at, and I also want to choose a strike price that I can buy at to protect my downside basically. So let's open up the daily chart here and do a little bit of technical analysis to see where the price of QQQ might go to. Well, I've noticed that we have this trend over here, which looks like it was broken last week. As you can see, it shot up, but it was rejected by this blue line, which is the EMA. And because of the hotter than expected CPI, we had a gap down today and the ETF is continuing to fall lower. So what I think will happen is the ETF over the next few days is going to come back down and retest the top of this range. So we're either going to see it come down here and bounce off and go back up and retest that EMA up here, or the price will fall through and it could reach the bottom of that channel. Since I'm doing a bear call spread, obviously I want the ETF to go down instead of up. However, I do want to put in a buffer in case the price does move up. So I think it's pretty safe around this EMA line over here. If this were to continue, that's looking like about the 310 level is where QQQ might head up to if it were to bounce off this line and continue higher. So that's going to be right around here, and I've marked that with this purple horizontal line. Where we go after that, it's anybody's guess, but I think in the short term, especially when this line used to be resistance before, I think it's possible that it could be a short-term ceiling for QQQ in the next few days. So between 310 and 314, I'll go 312, which will give me about 28 cents. And I'll turn on Strategy Builder here so that I can put in multiple legs. So I'm going to click on this red 28 here under the bid, and that puts the first leg down here. Then I'll go down and I'm going to choose my strike price that I'm going to buy for my downside protection. And how much protection you want just depends on how wide you want to make that spread. So the trade-off is the wider you make that spread, the more money you're going to make. For example, if I choose to buy this 318 call here, you can see the difference between the two, 28 cents and 8 cents is about 20 cents. So I can make $20. However, because the spread is so wide from 312 to 318, the most I can lose is actually $6 per contract. And if you multiply that by 100, then that's $600. So I would have to be willing to basically lose $600 just to make $20. Whereas if I choose a narrower spread, let's say I go with 313 here. Well, the good news is the most I can lose is just $100, right? The difference between 313 and 312 times 100. But you can see because I am paying $22 to buy this option, that's not going to leave me with much money after receiving $27 from selling this one. So that's about a $5 or $4 difference between the two. So that's the kind of trade-off you have to decide for yourself. In my case, I would probably choose, in this case, a 317 here, which will give me a $5 spread. So I'm choosing to buy this option and I'm selling that option. And here you can see IB is telling me I am doing a bear call. And if I look at the profile for this trade, it pretty much looks like what I've been drawing out earlier. There is a 92% probability that this will be a profitable trade with a max loss of $482, which is the spread, which is the $500 spread, minus the net premiums that I'm going to make from this trade. So here you can see my break even is at 312. So basically from now until Friday, I do not want QQQ to go above 312.17. Otherwise, I would be losing money. And the ETF is trading at 297 right now. So not very likely it will go above 312. Looking at the delta here, there is only a 7% chance. But the markets are very volatile now. So who knows? It's always a good idea to keep an eye on these things even after you've put in the trades. So for the price here, I'm going to choose pretty much the mid, which is 20. And that's going to be the difference, of course, between my short call and my long call. You can see the bid ask here for the option I'm selling and the option I'm buying. And for the quantity, let's go with maybe 5. So that way I can make like $100. And you can see the margin impact here, which means how much capital I would need to make this trade, is about $3,300 Canadian. And if I submit this order, it's saying I'm going to pay between $2 and $12 in commission. So my total will probably be around $92, which is the premium I'm going to receive. And that's going to be the maximum profit that I can make, assuming both options expire out of the money, which is what I want ideally. Okay, so I just basically hit transmit, and I'm going to wait to see if this fills. Looks like this has dropped, the mid price has dropped to 19, so I'm going to go down just 1 cent and hit update. So while I wait for that to fill, I'm going to talk about the second situation where using the bear call spread might be a good idea, and that is to use it on overvalued stocks.
Order partially filled.
And here we see
Order filled.
trade has gone through at basically 19 cents. Okay, so let's take a look at an overvalued stock, Eli Lilly, which is a large pharmaceutical company. We can see that the 1-year price estimate that analysts are expecting for this company is $304 per share, and right now we're at 308. So the stock is actually trading at a premium to what the stock should be at 1 year from now, which kind of gives you an idea of how overvalued the stock is. If we take a look at the PE ratio here, it's at 49 times. Now, for a PE ratio to be that high, you would expect the earnings to be growing very fast, right? I think Google is trading at a PE of around 20, and Google is expected to grow at like 14 or 15% a year. But let's see how Eli Lilly is growing. This is using ROI.ca's website. And we can take a look at the earnings per share. So over the last 5 years, they went from $3 to $8 to $6, and then over the last 12 months, 6. So it's not really growing over the last couple of years. However, you can see the stock, for some reason, has just gone way up. Now, is it because investors are using a different metric, like maybe price to sales or revenue growth? But if we look at the revenue per share here, which is the top line, we can see that, again, over the last 5 years, not much growth from 23 to 23 to 25 to 31. That's not the kind of growth you would expect to see for a stock that is going up from like $150 to $300. It didn't even correct since the beginning of this year, like the index has. But maybe Eli is like one of those companies like Constellation Software, where it just always commands a higher valuation compared to other companies. Well, let's take a look at historical valuations. So they had negative earnings in 2017, but then next year about 30, and then 13, 22, 36, and now we're at 50 or 49 according to Yahoo Finance. On a valuation basis, this company is expensive, but that's just my analysis. Let's take a look at what analysts are saying about this company. On Morningstar's stock report, we can see down here that LLY is overvalued at 13%. And taking a look at the Refinitiv stock report, if I go down to the fundamental valuation metrics here, we can take a look at the company from a price to sales perspective. And it looks like we are at, looks like one of the highest points in recent history. So the 5-year average is around 6, but right now it's at 10. PE ratio, we already talked about that. It's looking very elevated. The 5-year average is 37, but we are now at 50. The forward PE ratio is also very high compared to what it was over the last 5 years. So objectively, I think this is an overvalued stock, which means it probably doesn't have a lot of further room to grow. So this would be a good candidate for using a bear call spread because this option strategy requires you to have a bearish bias for the company. So let's take a look at LLY in the option chain inside Interactive Brokers. I'm going to choose the same expiration date as QQQ, September 16th. And I'll take a look at the chart here, LLY. Okay, so this is pretty interesting because the medium-term price movement of the stock doesn't feel like it's bullish or bearish. As you can see, it goes up and down, but it crosses over the EMA, which is usually not the case. So it's a little bit harder to read maybe this stock than some other stocks. So I'm going to turn on a Bollinger Band to help me kind of derive where the standard deviations are. This is using tradingview.com, by the way, a really cool free tool anybody can use. So what Bollinger Bands do is they kind of have this upper line and this bottom line that tells you where the stock will likely go 2 standard deviations out. Now you can change that to 1 or 3 standard deviations, but 2 will give you pretty good odds at about 95% accuracy. So the top of this Bollinger Band here looks to be at 326. So I'm going to see in the option chain what kind of premiums I can get if I sell the option at 326. This is looking at LLY. We have a 325, and that looks like somewhere between 32 and 115. That's quite a wide spread between the bid and the ask. If I make the sell leg here and I buy it here, let's say at 330, this means the most I can lose on one contract is $500 minus, it looks like about $48. So for the quantity, I'm going to choose maybe 8 here. And you can see the mid here is going to jump up and down a lot because the spread between the bid and the ask for these options are quite wide, but I'll just go with 46 for now. And that's going to require about $5,200 to make this trade, which I have. Okay, and I'll submit that. And sometimes it will be the case that after you make a trade, the mid price will go down a lot. So I'm going to drop mine down to 30 and click update. And I may have to drop this down lower later, but we'll see what happens. And finally, let's talk about the third type of situation where using this tool would be appropriate, and that is to play earnings. Now, this can be a little bit risky because if you get the direction wrong, there is a chance that you could lose out on this trade, but you can always go further out of the money to kind of have a larger buffer. So on Fidelity's website, you can search for company earnings by date, and I noticed that later this week, on Thursday, Adobe is going to come out with its earnings. Now, heading over to tipranks.com, if I look under earnings for Adobe and go down to see what the price movement of the stock did a day after earnings was released over the last few years, we can see that it's been kind of all over the place. We had a huge surprise in March of 2020 where the stock shot up 17%, but then other times it went down 10%, like in December last year. However, most of the surprises in the most recent quarters seem to be down. So because over the last year, it seems like earnings reports have disappointed, I'm going to continue and stick with that trend and assume that the stock will probably go down after its earnings this week. So I'm actually going to go with 425 here. That's a delta of 6.2, which I think is low enough for the risk I'm taking. And for protection, maybe I'll go with a 440 here. So that's going to give me a net premium of around 32 cents. Let's go with a quantity of maybe 15 because I'm feeling quite confident about this trade. Oh, and now the mid price is higher. So that's going to be about $488. My Illy Lily hasn't gone through yet, so I'm going to see what the price on that is now. It's at 18. Okay, I'll choose that and update. For Adobe, I'll go down to 27, update.
Order partially filled. Order filled.
I'll drop down the price of LLY to 12.
Order partially filled. Order
Okay,
filled.
so now all three have filled. So I've sold 3 bear calls today. We have the Adobe bear call, we have LLY here, and we have a bear call on the triple Q, all expiring on September the 16th. So let's see how these trades do on Friday.
3 days later.
All right, it is Friday. So all 3 of those trades should be expiring today. So for index funds, they usually don't move too much, but this week was kind of special. The QQQ ETF is almost down 7% for this week. So the bear call spread with a short call at 312 strike is definitely going to expire out of the money. So I will capture 100% of the profits from the premiums. And because almost all stocks have sold off so much lately, it's pretty much the same story with the other trades. I think my strike price was around 325, and I got to that target with the help of these Bollinger Bands. I put in the trade on Tuesday when the market was down here, so it could have gone up, it could have gone down, but it stayed between the top and the bottom bands. So LLY also expired worthless. If we see here in my portfolio, both the short calls as well as the long calls are now worth 0. And finally with Adobe, my short call was at 425 because I expected the stock price to drop after earnings based on the trend of recent quarters. And Adobe dropped quite a lot after they released their financials. But it actually wasn't a really bad quarter. It was a little bit mixed, but I think most of the huge sell-off in Adobe was from the acquisition of a design company called Figma. They purchased it for $20 billion, which investors of Adobe did not like, which means the option strategy is now worthless. And I sold it for 26 cents, so I'll be able to realize the full profit on that as well. Now, even though these particular trades worked out well, which is most likely going to be the case, but there will be times when the market is going to move against you, and that's when you have to basically close out your position before the loss starts to get too expensive. So for each of these trades, I would look at the maximum profit that I could make. For example, with Adobe, it's about $400. So if I start to see the unrealized profit loss go like to minus 300 or minus 400, then I would just close out that position. You can right click and close, which will basically buy back the short position and sell to close the long position. So I didn't need to do that this time, but it's something to be aware of so you don't get caught with like a really big loss. These trades are already favorable, so don't feel like you have to make each one profitable. It's better to take the small losses and let the winners ride. And over the long run, if you use this strategy in the right situations, you should be able to win more times than you lose. So the situations you can use the bear call spread again are on index funds that you feel comfortable trading. You can also do this on some kind of underlying that you feel is overvalued, because if the stock market goes into a correction, usually it's the really overvalued stocks that fall first. And finally, you can play with earnings, as long as you remember to give yourself a wide safety buffer, just in case the direction that you think the stock will go after earnings goes in the wrong direction, which can often happen. And of course, with all that said, it's still important to be mindful of where the market is going overall, because if we have a raging bull market, it's probably not a good idea to use the bear call spread, because then you're at more risk of your options being in the money. But as long as you're careful and you control your position sizing, then it shouldn't be difficult to manage your risk. Here I have some other bear calls that expired worthless today. Snow, SPX, PayPal. These are small profits, but they add up over time. So what I typically do is spread out my bear calls across the week on multiple underlyings. And if the conditions are right and I keep on top of things, I can typically generate around $1,000 using this strategy. Now, on the other side of things, if we are in a bull market, which right now we're not, but eventually I think we will be in one again, then the opposite of the bear call spread is the bull put spread, and I'll be doing a video on that in the future. In the meantime, if you want to see how I anticipated the markets going down this week, you can check out my previous video where I broke down the S&P 500 and predicted that we were heading lower. Good luck with your investments, and I'll talk to you in the next one.